What would you do if $8 billion of other people's money vanished overnight, and you were the one who had moved it without anyone signing off? That's not a hypothetical. It's exactly what happened at FTX, once the second largest cryptocurrency exchange in the world, run by a 29-year-old who was, for about 18 months, treated like the smartest person in finance. Then, in a single week in November 2022, all of it came apart. The company, the reputation, and roughly $8 billion of customer deposits that were supposed to be sitting safely inside the exchange, waiting to be withdrawn whenever their owners wanted them back. FTX was founded in 2019 by Sam Bankman-Fried, a former Wall Street trader and the son of two Stanford law professors, together with Gary Wang, a former Google engineer. Bankman-Fried had worked at the quantitative trading firm Jane Street before starting a separate company, Alameda Research, in 2017 to trade cryptocurrency, and then FTX 2 years later to build the exchange he thought serious traders actually needed. The idea worked. Within 3 years, FTX and its US-facing arm were processing billions of dollars a day, serving millions of users worldwide, and had attracted investment from some of the most respected venture capital firms on earth. Sequoia Capital, SoftBank, Singapore's own sovereign wealth fund, all buying in at a valuation that eventually reached roughly $32 billion. On paper, Bankman-Fried's own personal fortune was estimated at close to $26 billion at its peak, making him briefly one of the richest people in the world under the age of 30. He described himself publicly as a believer in effective altruism, earning as much money as possible in order to give nearly all of it away, and used that idea to explain why he dressed casually, drove an ordinary car, and reportedly slept on a beanbag chair at the Bahamas headquarters where FTX was based. He testified in front of Congress, lobbied heavily in Washington around crypto regulation, appeared on magazine covers, and was held up in the press as a new, more responsible kind of crypto entrepreneur. FTX's logo went on Major League Baseball umpires' uniforms. It paid roughly $135 million for the naming rights to the Miami arena where the Heat play. Tom Brady and Steph Curry starred in its ads. Celebrity investor Kevin O'Leary became a paid spokesperson, and Larry David fronted a Super Bowl commercial telling viewers not to miss out. Behind the polished public image was a structure almost nobody outside the company fully understood. FTX ran alongside Alameda Research, the trading firm Bankman-Fried had started earlier, run day-to-day by Caroline Ellison. On paper, they were separate companies. In practice, the line between them was thin to the point of barely existing. FTX had no traditional board of directors with independent authority, no chief financial officer empowered to say no, and none of the separation between customer deposits and company money that a regulated bank or brokerage would have been legally required to maintain. Customer funds sent to FTX were, in some cases, routed through a bank account technically owned by Alameda Research. Decisions of enormous consequence were later described as running through one person, informally, rather than through any formal process at all. Former employees later described a company run less like a business handling billions of dollars that belonged to other people, and more like a small group of friends making enormous decisions together in a group chat. For a while, none of that seemed to matter, because the money kept coming in. Alameda Research borrowed heavily from FTX, using a token called FTT, created and issued by FTX itself, as collateral for those loans. It's a bit like a company printing its own certificates, declaring they're worth billions, and then borrowing real money against them. FTX's own auditors were two little-known accounting firms, unusual choices for an exchange handling this much money, and neither one flagged the arrangement publicly. As long as confidence in FTX held and nobody looked too closely, the whole structure could keep spinning indefinitely. Analysts, journalists, and even some of FTX's own investors either didn't ask the obvious question or didn't get a straight answer when they did. What exactly was backing customer deposits, and where were those funds actually being held? The answer came out in early November 2022, when a leaked Alameda Research balance sheet, published by the news outlet CoinDesk, revealed just how dependent the firm was on that self-issued FTT token. Within days, Changpeng Zhao, head of rival exchange Binance and an early FTX investor, announced Binance would sell off its entire stake in FTT. That single announcement triggered a bank run. Customers rushed to pull their money out of FTX all at once, the way depositors run on a bank rumored to be in trouble. On November 8th, FTX froze withdrawals. Binance briefly signed a non-binding agreement to acquire the company, then walked away the very next day, citing mishandled customer funds and reports of federal investigations. FTX couldn't cover what customers were owed because billions of dollars in deposits that should have been sitting untouched had in fact already been moved. Into Alameda Research, into venture investments, real estate, and loans to executives. On November 11, 2022, FTX filed for Chapter 11 bankruptcy, listing more than 1 million creditors. Sam Bankman-Fried's paper fortune, once close to $26 billion, was effectively wiped out within days. The company's new CEO, John J. Ray III, who had previously overseen the liquidation of Enron, wrote in his first court filing that he had never in his career seen such a complete failure of corporate controls. The shock spread through the rest of the industry too, dragging down other crypto lenders that had exposure to FTX or Alameda in the weeks that followed. Bankman-Fried was arrested in the Bahamas the following month and extradited to the United States. Caroline Ellison and Gary Wang pleaded guilty and became the government's star witnesses, testifying in detail about how customer funds had been used. In October 2023, Bankman-Fried stood trial in New York. His defense argued he had made reckless business decisions but never intended to defraud anyone. The jury didn't agree. After only a few hours of deliberation, they convicted him on all 7 counts of fraud and conspiracy he faced. In March 2024, he was sentenced to 25 years in federal prison. The company that had briefly been valued at $32 billion, that had bought a basketball arena's name and a Super Bowl ad, turned out to have no real financial controls behind any of it at all. Here's the twist almost nobody expected. Years later, as the bankruptcy case wound its way through court, the value of the crypto assets FTX still held had risen so much that the estate ended up with more than enough to repay creditors in full, in some cases more than what their accounts were worth the day the company collapsed. The money, in other words, wasn't gone because it was unrecoverable. It was gone for years because nobody with real authority had ever kept track of where it went or stopped it from being moved in the first place. So what actually killed FTX? It wasn't a bad trade, a market downturn, or bad luck. It was the absence of the most basic thing a company handling other people's money is supposed to have: a real boardroom with people in it who had the power to say no. There was no independent board asking hard questions, no CFO with real authority to block a risky loan, and no wall between customer funds and company funds that anyone was actually enforcing. $8 billion didn't disappear because it's hard to keep track of that much money. It disappeared because nobody with real power was ever assigned to keep track of it. That's the pattern behind almost every company that collapses this fast. Not one dramatic villain acting alone, but an empty chair where oversight was supposed to sit.